So as far as the launch timing is concerned, one, as far as the regulatory approvals and the regulatory framework in mind, till now in India, there wasn't a regulatory framework for silver. Thanks to the regulators' proactive, steps, we have been able to get the regulations, and most of the asset management companies in the ETF business would probably come up with a silver ETF. We are very happy that ICICI Prudential Asset Management Company is being able to bring out India's first silver ETF. So from a timing perspective also, we have got the advantage of the fact that silver for the last 10 years has underperformed equity. You mentioned about how Nifty has touched a particular number. So last 10 years, market returns have been in excess of 10% on a CAGR basis, while silver has given only probably about around 2% CAGR. In other words, on a 10-year basis, silver has underperformed the equity markets. So from a relative valuation or a relative performance perspective, silver has underperformed. And more importantly, as we speak currently, silver is being utilized in many sunrise sectors like electric vehicles, 5G mobile technology, and solar energy cells or solar energy ecosystem. We all know that all three of these are likely to see growth, which essentially means silver's demand as a commodity for industrial use in these sectors will also keep growing, which also makes silver a good commodity to be invested in. And today, as more and more people are probably looking at avenues to diversify their portfolio, and they are investing outside of India or in some commodities or in some various financial instruments, gold and silver become a very good addition for the investors' overall portfolio diversification. And they are one of the longest serving stores of value as well as wealth creators for human beings in general. Hence, we believe that launching of silver ETF in terms of timing currently is beneficial for the investors who have a medium to long-term view, and they may get benefit of the price rise in silver after 10 years of consolidation that may come in the next 2 to 3 years. Thank you. So over the last many decades, if we see, gold prices and silver prices generally have moved in tandem. In other words, gold and silver prices move together. Silver being a commodity which is probably higher beta in terms of its price, it moves a bit more than gold whenever the move comes. Both sides, up and down, silver moves a bit higher than gold. In terms of performance, if we see over the last 10 years, gold in Indian rupee terms has done slightly better than silver, which makes silver even more attractive relative to gold as we speak. But because silver is more volatile in general, we are recommending to investors that for every 2 rupees you have in gold, you invest 1 rupee, or whatever money you have in gold, 50% of that you may want to allocate to silver if your overall asset allocation allows you to. Because both these asset classes, while they move in tandem, whenever the uptick comes, silver can move higher. And since the beta of silver is more, maybe currently, if we look at from a ratio perspective also for gold and silver, it is suggesting that gold and silver both should be in an investor's portfolio, and almost whatever gold you have, 50% of that in terms of value, you can have silver as part of your portfolio diversification. So if we look at correlation of the asset class, that is silver and gold with equities or debt, it has a very low correlation or even a negative correlation, if I may say so. If we look back, say January 2008 to somewhere in mid 2009, equity markets, or say March 2009, equity markets had come off by almost 50% in that time period from Jan of 08 to March 09, while silver prices actually in that time period had gone up by 10%. So you can imagine that equities came down very sharply from an overvaluation stage, while silver actually outperformed and gave a positive return. I think whenever there is volatility in the markets, people turn towards a safe haven asset. Gold and silver typically are considered to be safe haven asset, and currently with interest rates being low, money supply being strong, and inflation being high, generally this trilogy supports silver and gold prices. And given that equity valuations have already got re-rated over the last 1.5 years, silver becomes a good asset class for investors to diversify and put their money in, is what we believe in. Thank you. Yeah, so retail investors, for every 100 rupees, for example, that you have in financial assets, you would typically have 50 to 60%, or you should typically have 50 to 60% in dynamic asset allocation fund category, right? That is the balance advantage fund category. The balance 20% you would have probably in debt as a safety net, any fixed income instrument. Currently, we prefer the accrual category or the floating rate fund category for that 20%. So 50 plus 20 is 70. The balance 30%, you can invest maybe 15% out of it in international equity. Our current preference is Asian equity. So there are fund of funds who basically allow you to invest in international equity. You can take advantage of that. And 15% of your overall portfolio can be in international equities, specifically targeted at Asia. And the last 15% is where gold and silver will fit in. I think 10% in gold, 5% in silver is the ratio which should be there. So if you have 100 rupees, 10% in gold, 5% in silver is the comfortable mix right now. The balance 85%, like I said, should be in dynamic asset allocation fund category, about 50%, 20% in debt, and 15% in international equities. Thank you. Yes, so since ours is the first ETF, we expect a lot of investors to start getting interested and invest in it. So natural liquidity on the exchange will definitely be there from investors who are buying and selling once their NFO period gets over in the ETF. Over and above, obviously, the investors who will invest in the ETF or the fund of silver, which is there where the investors would probably allocate money, that will also be investing in the ETF, which will also help screen liquidity if the buying and selling is happening on the screen. And third and most important, much like how in gold ETF, there are authorized participants or market makers who are ensuring liquidity on the exchange at fair prices with minimal spreads. The same concept will apply in silver as well. The authorized participants will help the asset management company and the investors to have liquidity on the exchange at a fair price and minimal spreads. Because the ecosystem of silver in terms of physical market is pretty strong. And to convert that into the financial market or the ETF market, the market makers or authorized participants who have been appointed, they will play a crucial role. And we believe that as asset management companies, the way we've been able to manage gold, we'll be able to manage silver ETF as well. Yeah, so if you look at the rolling 3-year, 5-year, and 10-year returns, unlike in equities where the time period or the market cycles are shorter, in silver, we have longer time periods or longer time periods of consolidation, much like gold as well. So 2011-12 to 2019, we saw silver consolidating after the initial correction. And so we had 7 to 8 years of consolidation. So in that period, the rolling returns on 3-year, 5-year, 7-year would look very weak. However, if I look at it today, since silver has actually moved up from 32,000 rupees in Indian market to almost 62,000 rupees from March 2020 to date, and that too, I think March 2020 to August 2020 itself, the silver moved by more than 100%, and then it's been flat. Because of the sharp up moves that silver has in short time periods, the rolling returns of silver actually do not compare well with equities. But that's where silver and gold as a tactical asset right now for the next 3 years suit well. We are not making a case that gold and silver should always be a part of investors' portfolio. I think the 0 to 15% range that we have for gold and silver is applicable today because of the valuations of equity markets becoming expensive. Interest rates likely to go up and inflation rate going up means that debt as an asset class is not that lucrative. That makes gold and silver attractive relatively, and hence we are recommending 10% in gold and 5% in silver, with the expectation that in the next 2 to 3 years, if there is a big spike in gold and silver, investors can get the advantage of that and then probably relook to move out of silver and gold. So silver and gold are tactical investments, and the timing today is pretty good the way we see it. Hence, if you look at the rolling returns over 3, 5, 10, 7 years today, they may look reasonable. But I would say, given the nature in which silver has these huge spurts, it is very important for investors to time it. And obviously, 1 year back, the timing was even better in March 2020. But even today, silver on a 10-year basis has virtually given no returns. And hence, we expect over 3 years, silver and gold may end up giving returns. So do have portfolio diversification approach in which you end up having gold and silver as part of your portfolio. Again, to reiterate, gold ETFs if you have, or gold if you have, whatever gold quantity you have, you should have 50% of that in silver, because both of these in tandem can potentially help you get better risk-adjusted returns when the spike in these metals happen. Thank you.